Welcome back to Investing Talk Podcast.
Today we're looking at strategy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have a mountain of information on strategy, and the headline here is it's just intense profitability.
Intense profitability.
Yeah, and it's backed by what looks like rock-solid dominance in their specific software sector.
Okay, let's unpack that, because when we look at the fundamentals, some of these numbers, they don't just look good, they look almost unbelievable. What's the one metric that just jumps off the page?
It has to be the margins. Their operational efficiency is truly exceptional.
Okay, so what are we talking about?
We're talking about a gross margin over 70%, which is fantastic for software. But the number that makes you do a double take is the profit margin.
And that is?
A staggering 1,667.09%.
Wait, 1,600%. I have to stop you there.
Yeah.
For anyone listening, a good profit margin might be, what, 20%? How is a number like that even possible?
That is the critical question, and it really signals a major competitive moat. Their business model, with software intelligence, means the cost to serve one more customer is almost zero.
So it's pure scale.
Pure scale.
Yeah.
And that translates directly to how much profit they squeeze out of each employee.
And that number is just as wild, right?
It is. It's $5.03 million in profit per employee. It just shows you the sheer leverage they have on their intellectual property.
So it's a profit machine. How does that turn into actual earnings for investors?
It drives incredibly powerful earnings. Their trailing 12-month net income hit $7.72 billion.
Wow.
Which gives you an EPS and earnings per share of $27.34. But here's where it gets really interesting for investors.
The valuation.
Exactly. The price-to-earnings ratio is just 6.24.
A PE of 6. For a tech company with those margins, that's incredibly low. It suggests the market thinks the earnings aren't sustainable.
Right. But the forward projections look strong. Analysts are expecting solid sales growth to continue right into early 2026.
So with that kind of earnings power, the balance sheet must be absolutely pristine, right?
It's healthy, but I wouldn't say pristine. There are some things to watch. I mean, the return on invested capital is solid at 18.46%. That's great. And the price to book is right near intrinsic value.
But there's a but coming. I can hear it.
There is. The potential issue is liquidity. The working capital ratios are tight.
How tight?
The current ratio is 0.66. The quick ratio is 0.52.
So for our listeners, a ratio under 1 means they don't have enough short-term assets to cover short-term debt. How risky is that?
Right now, their high profitability mitigates that risk. They generate cash so fast they can meet obligations, but it's something that needs to be monitored very closely, especially if they try to expand aggressively.
So a strong business, but tight on working capital.
Yeah.
Fascinating dynamic. Let's pivot to the stocks action. What are the technicals telling us?
Technically, the trend is robustly bullish, very strong.
In what way?
Since about July of 2025, the stock's been charting higher lows and higher highs. It's the textbook definition of a solid uptrend.
And what are the key levels people should be watching? Where's the floor and where's the ceiling?
The support is pretty well established around that $166 to $180 range. On the upside, the immediate resistance, the wall they need to break through, is between $290 and $310.
And if it breaks through 310,
then you could see a really significant move. The path could open up toward the prior highs, which are way up near $543.
that's a huge potential upside. But what about the ride to get there? How volatile is this stock?
Oh, you need to buckle up. This is a high beta stock. The beta is 3.37.
So in simple terms, if the market moves 1%, this stock tends to move over 3%.
Exactly. The swings are pronounced, which is great for traders, but it definitely increases the risk.
And right now, are momentum indicators suggesting it's a good time to get on that ride, or is it overheated?
Actually, the setup looks pretty constructive. The MACD is positive, which is good, but the stochastic RSI is near 2.95.
A reading that low suggests it's approaching oversold territory.
Precisely. In a strong uptrend like this one, that can signal a potentially attractive entry point for people looking to catch the next leg up.
Okay, so that's the setup. Let's talk about the catalyst, because there are some massive changes happening right now. Let's start with the big capital move.
This is a huge deal. Strategy just completed a major financing event. They offered 7.75 million shares of a new 10% Series A perpetual preferred stock.
So they raised $620 million. A 10% yield is not cheap money.
No, it's not. It suggests they have a very high return use for that capital in mind, or they really wanted to avoid diluting the common stock.
And the first dividend payment on that is coming up soon.
It is December 31st, 2025. That's a key date for institutional holders.
And this is all happening while there's a major transition in the C-suite.
Exactly. The EVP and general counsel is retiring, effective that same day, December 31st.
And we've seen them selling shares.
We have, but it's part of a prearranged plan, a 10b5-1 plan, linked to the retirement. So it's not a sign of panic.
But the timing is remarkable. A key executive leaves right as this new complex capital structure comes into play.
It definitely raises questions. It points to potential governance risk and a real transformation underway. So you have to wonder about succession planning.
Which makes the next 3 months absolutely critical. What are the big triggers on the calendar?
The quarter is packed. First up is the Q4 2025 earnings announcement. That's tentatively scheduled for early February 2026.
And the market will be watching for continued growth there.
Yes. Any deviation from that will move the stock sharply. Second, you've got market flows,
ETF rebalancing.
ETF rebalancing in January, and then institutional buyer filings in February. The new preferred stock could change how indexes weight the company, driving a lot of volatility.
And third,
Product announcements. We expect them at the Investor Day in December. They need to show they're reinforcing that competitive moat, probably with next-gen analytics or AI features.
so those are the knowns. What about the rumors? What's the speculative chatter around a company that just raised over 600 million euros?
The loudest rumor is about how they'll use that capital. There's a lot of speculation that they could use it to significantly bolster their digital asset holdings.
If that happens, it completely changes the investment thesis.
Completely. The stock would become even more correlated to cryptocurrency volatility. It adds another powerful layer of risk and reward.
Any other whispers? Maybe about corporate structure.
Yes. Chatter about potential inclusion in a major index, like the S&P 500, now that their public float has increased.
That would be a game changer. S&P 500 inclusion forces passive funds to buy.
It's mandatory buying pressure. Huge. We've also heard whispers about a potential spin-off of their legacy business or even an accelerated share buyback. But those are, unconfirmed.
Still, it shows the market is anticipating some big moves.
Absolutely. The level of interest is very high right now.
So let's tie it all together. What's the final picture for someone looking at strategy today?
Strategy presents a really compelling but complex picture. On one hand, you have these outstanding fundamentals, the insane margins, the strong earnings, a low PE, plus a strongly bullish technical setup.
And on the
other hand, you have to watch those low liquidity ratios very closely. You have to be prepared for the high volatility that comes with a beta over 3. And you have the uncertainty of a major leadership transition happening at the exact same time as a huge capital structure change. It's a story of high reward potential, but it's definitely not without significant risk.
A fascinating intersection of operational excellence and high-stakes capital markets engineering. It really seems that the big question isn't if they can make money, but if they can manage all this change. If you want more in-depth analyses like this one, make sure you hit that subscribe button.